Hi everyone, myself Dr. Pradeep Reddy, Associate Professor, Sage University, Bhopal, would like to bring you about arbitrage pricing theory or model. As you all know that the importance of this arbitrage pricing theory is very much. And let us see in this video what is the importance of this model. So basically, what is arbitrage pricing theory is? It is a well-known method of estimating the price of an asset. The theory assumes an asset's return is dependent on various factors like macroeconomic, market, and security specific factors. Because as we all know that as the price of the shares or bonds will be moving according to the market situations, and the market accepts everything, the information that is from the society, from the government, the procedures, policies, everything, a hot news will be affected to the market situations. So these are whatever the macroeconomic factors, market situations, and the specific factors are related to the change in the price of a product. And what is the general idea behind this arbitrage pricing theory is that is two things can be explained: the expected return of a financial asset through macroeconomic and the asset's sensitivity to those influences. So that's why whenever we choose securities in the market, we have to look upon these two aspects which are very important for us. One is the macroeconomic factors and the sensitivity of the price of the asset to that particular issues. And what is this basically theory explains about is the model of pricing that is based on the concept that an asset can have its returns predicted. To do so, the relationship between the asset and its common risk factors must be analyzed. And the second thing is Stephen Ross in 1976, in order to examine the influence of macroeconomic factors that allows for the return of a portfolio and returns of specific asset to be predicted by examining the various variables that are independent within the relationship are explained in this model, so that an investor can understand what type of securities he can choose when he is going for investment. One is the macroeconomic factors and the sensitivities towards that particular stock. And the formula that is used is Stephen Ross has developed in his theory in 1976. And the formula is, if you look into the expected return, that is the rate of return that we expected, is equal to RF plus BJ1 RP1 plus BJ2 RP2 plus BJ3 RP3 and so on up to BJN RPN. So the meaning of it is whatever the amount of risk-free assets that we include in our security is directly dependent upon the sensitivity of the assets return, which is the particular factor that we are looking at, and what is the risk premium associated with that particular factor when we choose the security in this aspect. So what is my expected return is based on the risk-free return, and the specific factors that are associated to the market has been kept in this model to explain about, to calculate the expected return of the particular securities. And the security specific influences, what type of specific security influences will focus on the security are the inflation, production measures, investor confidence, exchange rates, market indices, and changes in interest rates are some of the examples wherein we have looked into the particular aspects upon which the share prices are fluctuating. For example, if there is inflation in the economy, automatically the share prices gets down, because we don't know that when what will happen when the inflation will prevail and to what aspects this inflation will cause to, so that people or the investors will having some dangerous aspect signal that they should not be investing in an inflation period. And with related to the production measures also, certain companies will be taking these aspects that we have to restrict our production based on the demand and supply. We have to restrict ourselves in order to create monopoly nature in the market. And the next one is the investor confidence. If investor is confident about the market and if he is ready to take risk, he can invest. And if he is a rational investor and he doesn't take risk, he cannot, his confidence level is somewhat less. So, and the changes in the interest rates also lead to the specific factors which leads to the confidence of the investor, so that he can decide upon which stocks he can invest upon. And relating to the pricing, once the analyst derive the expected rate of return of asset from the arbitrage pricing theory, he would decide the correct price of the asset. And if we apply it to portfolios as well as individual securities also, a portfolio can have exposure and sensitivities to certain kind of risk also, so that we can decide what kind of pricing we can adopt to the securities, so that we can understand whether we will be in a confidential level or we can build our confidence in order to pick up the securities or not. So why does arbitrage portfolio theory really matters us? It is a revolutionary model, nowadays model. It allows the users to analyze the security. It is used to identify that either security is undervalued or overvalued. So can investors can get benefit through the information, and it is useful in formation of portfolio as it is provided information that whether portfolio is exposed to certain factor or not. So based on these criteria, an investor can understand the market level and the criteria level and his investment level. So when we look into the advantages of this model are, it has fewer restrictions, not like the CAPM model, capital asset pricing model. It allows for more sources of risk, and it does not specify specific factors, and it allows for unanticipated changes, and it allows investors to find arbitrage opportunities, investing in one market and selling the stocks in another market. And these are the advantages of this model. And when looking into the disadvantages are, it is customized than CAPM but difficult to apply, because hence we are specifying and restricting only on risk-free return and the securities and the n number of securities we are applying for it. And it generates a large amount of data, since as initially itself we have specified that we will be applying for n number of data. The data will be large enough in order to apply the formula, and it requires risk sources to be accurate. So at sometimes we cannot be so accurate with regarding to the risk sources, and it requires the portfolio to be examined singularly. It is which is at most a difficult thing in order to count down and evaluate each and every security to be examined, and it is not a guarantee of results. So looking into these theory as a whole is applicable for every one of us, and it is very best to the investors who is a layman can also can understand how the market is fluctuating and functioning. Based on that, he can analyze his securities. Keeping that in hope, this video might be helpful to you in understanding the arbitrage pricing theory model. Thank you, everyone.